Welcome to the FT headquarters for PWM's roundtable discussion on ETFs. The aim of this discussion is to get an indication of how fixed income ETFs are used in private client portfolios. I have with me several representatives of private banks, wealth managers and asset managers. Thank you all for joining me. In this first introductory section, we'll now discuss the outlook for fixed income in 2018. The big question is the three-decade bond bull market nearing its end?
I think we'd have to agree that that's the case. We know that this extraordinary monetary policy will have to come to an end, and will come to an end hopefully slowly, and we will see rates rise from this point. The goal of fixed income portfolio managers is to make sure that we can still have positive returns by looking for sub-asset classes of fixed income that are higher yielding, that can provide some form of cushion against this rise in government bond rates.
I think certainly this year is going to be a more challenged year, I think. We had a very, very smooth path for risk assets last year, and it was actually relatively benign on the rate side. So this year has started differently. We've seen a bit of a sell-off in rates. The US 10-year is obviously approaching 2.8. Many market participants probably predicted that would be the peak at around this year, that sort of level. The yield curve is pricing in roughly 3 hikes. We think that to the most extent the environment for high yield is relatively benign from a default environment, so we expect it to be a relatively coupon-like year, and we expect limited returns from more traditional investment grade and sovereign markets.
The majority of the rate rise we've seen so far this year has been driven primarily by inflation expectations. And you look over the last 2 years and it's been inflation that's been conspicuously absent. And there's lots of talk, you look at all of the underlying data, there's every reason to think inflation should come through from wage push inflation, but it simply hasn't manifested. And some of those signs, those tentative signs, are coming through, and that's being partly reflected in what we're seeing in nominal bond yields. I think the biggest worry in the markets is that central banks have spent the best part of a decade distorting them with extremely loose monetary policy, and when that's withdrawn, no one actually knows what's going to happen. And there is a risk that you can have a period, as we've had at points in the past, where you actually have solid economic fundamentals and growth, but the effect of QE and other central bank policies being withdrawn could lead to a correction in what could be quite fragile markets.
In terms of what it means for fixed income, I think our core view at the moment is the move that we've seen so far won't become a disorderly move in yields. The rises we will see in yields over the next 2 or 3 years in the US and perhaps globally will be slow and steady firstly at the short end on the interest rates, but actually further out on the yield curve as well. So our kind of Julius Baer, our view on high grade fixed income is whilst we prefer other asset classes, frankly, in terms of the returns that we think are going to be available, if our clients' needs can be met investing in high grade fixed income, we don't think there's anything to be worried about buying duration at this point.
We tend not to be more in the high yield. We tend to be more in the corporates and the government bonds. So we are aware of that yields are rising and equities are doing a lot better, but we still need to allocate a fixed income portion to the portfolios, which tends to be shorter duration.
There's no doubt that bond volatility is going to have to increase in a post-QE area. Fiscal policy expanding and monetary policy tightening are both bond negative events. Our view is probably bearish on sovereigns and supportive for credit given the fundamentals. But I think that volatility aspect is really key. And, I still think there will be periods of pullback in yields this year. I think yields will rally at certain points. I think there are opportunities for managers to be tactical, particularly on the sovereign side. There is still a lot of risk out there from a political perspective. If you look at economic surprises, they've typically been very high over the last couple of years. There's room for disappointment in the economic outlook. That said, from a fundamentals perspective, things look very strong.
When talking to your clients, do you perceive there is a change of sentiment with investors moving more into equity as bond yields are so low? The market share of fixed income ETFs on total ETFs decreased slightly over the past year to 15.7% from 16.7% at the end of 2016. So do you see any signs that the proportion of fixed income ETFs may rise in the future?
Yeah, it's a good question. I mean, I think the number you quoted, obviously a global number on fixed income ETFs, actually in Europe. So I think the AUM for fixed income ETFs is around 23%. But in 2017, we saw 26% of the flow going to fixed income ETFs. And that's on the back of a very strong equity market. So I think actually, people are allocating more to fixed income ETFs.
In Europe in particular.
In Europe particularly. So we're seeing investors very much move to places like emerging market debt, on the local currency side of things particularly, convertible bonds. And I think, there's something convertible bonds is a good example where obviously people are looking, and have to have an allocation to fixed income in their portfolios. But what's something that's going to act more like an equity in the markets that we've got? And obviously converts very much play that cool. So I think, we will definitely see continued fixed income flow, and we have this year, but people are just being much more selective about where they go.